Well, welcome everyone. This is to our advisors. This is first off, Rick Dwyer, Chief Operating Officer, Tactive. With me right now is Rob Isbitz, Lead Strategist for Sungarden. And based on some of the feedback we got from our advisors, we're going to change up the format a little bit. And so Rob, based on that feedback, the advisors are more interested in what's going on with your models. Are they changing positions? Or what are you doing with the models based on what's going on in the markets and why?
Sure. So, I have two models on the Tactive platform, so we'll make it nice and tight. Look, we are still in a downtrend with trading ranges within. And so what that means is there's not a lot of differentiation between this sector, that sector, this theme, that theme. So what do you do as a portfolio manager in those times? You use the old KISS method. You keep it simple, silly. So that's what we've done. We have a smaller number of holdings in each of our models than we've had in some time. I think it's likely to stay that way. Let me talk about the core portfolio. We've had a staple position in there, sort of a core of the core, if you will, which is the DIA, the Dow Jones ETF tracker. And I like that because the Dow's only 30 stocks. 20 of them make up probably 85% of the Dow. And we can use that as a kind of a core to work around. Where are we working around it right now? We're working around it. Again, we play offense and defense at the same time. That's our thing. So on the defensive side, we have a couple of items. One is we are short the S&P 500. You could interpret that as saying, well, we've got more Dow long than we are short S&P. And what that means is that I think the Dow is going to outperform the S&P. And this is a environment where it's going to be very, very difficult, I think, to make sustainable returns. So the whole portfolio, at least with core, almost becomes more of an arbitrage. So we've got the DIA and the SH kind of offsetting each other, but with the DIA winning, I'm happy to say. The other defensive position right now is in VIXI. The VIX is testing my patience. I don't mind telling you. It's kind of gone nowhere. It's high, but it's still in the 20s. And the reason you own VIXI is to see it explode, up into the 40s, 50s, 60s. I think that's something we'll see more likely later in the summer, early in the fall, when the markets get really, really rough. This is kind of summer doldrums trading range, but still very much a bear market and still very much a tough hill to climb for equities. So what do we do on the long side? The two positions we have right now are XLG and XT. XLG is a more concentrated version of the S&P 500 because it only uses the top 50 stocks. It's not quite NASDAQ-y, but it's definitely a little bit more aggressive. That is a very temporary position designed to try to capture a little bit more of the growthiness, techiness of the current market. And then XT is invest in what they call exponential technologies. It's sort of like the ARK fund without all the craziness and the hype and the active management, which caused that thing to drop out at 60 or 70% from its high. XT is kind of like, I would say, the grown-up version of investing in industries of the future. And so that's kind of part of the growthiness. I'm going to quickly move over, unless you have any questions on that. I'll just move over to the growth portfolio, and I will talk about that. And by the way, that approach to core, that's why we've pretty much been within 5% of break even all year. My philosophy is not dive into cash and then figure out when the market looks good again and when it's a bull market, and then jump back in with both feet. I know that's how a lot of folks do it in the tactical world. I've never really done it that way. And so as a result, this is where you try to pick your spots almost like a little whack-a-mole and try to find areas of opportunity. Very, very tough to find sustainable ones. So quickly on the growth portfolio, our core position there is OEF. It's the top 100 in the S&P, so a little more tech and FANG concentrated. We are complementing that. There's very little hedging in here. The only hedge we have right now is a modest position in VXX, which is just like VIXI in that it if volatility goes flying because the market's crashing, that thing could double, triple, quadruple, or more. So the main complements to OEF, the S&P 100. Right now, we own SDOG, which is a dividend, equal weighted dividend play. And then we own a couple of, let's say, more sexy ones, Block, BLOK, which basically invests in the companies behind the blockchain, which to me is a more sustainable story than the cryptocurrencies themselves. And then lastly, one that's not working out too well so far because commodities are become a real mess lately, and that is the ETF that tracks palladium, and we have a modest 5% position there. So that hopefully that gives you an idea, Rick, and gives the advisors an idea that you know, we're not making any crazy moves here. It's too trading rangy, it's too uncommitted, and I still believe the general market, stock market, is going to head much, much, much lower, but it may not happen until summer vacation's over.
Well, Rob, you gave us and our advisors a lot of information in a very short period of time. I appreciate that. And advisors, if you have any questions on what Rob's doing with his portfolios or how he may be able to help you with your clients, feel free to reach out to Rob Isbitz at Sungarden. Rob, thanks for your time. We look forward to talking to you next week.
Thank you, Rick.